Today we'll embark on an in-depth journey through Chapter 1 of Ben Graham's seminal work, Security Analysis. This chapter, titled The Scope and Limitations of Security Analysis, the Concept of Intrinsic Value, lays the foundation for understanding the core principles of security analysis. Our goal today is to ensure that by the end of this lecture, you will have a thorough understanding of every nuance and insight Graham intended to convey. Security analysis, as defined by Ben Graham, is the careful study of available facts with the attempt to draw conclusions based on established principles and sound logic. This approach is part of the scientific method. However, unlike pure sciences, investment is not an exact science. It shares similarities with law and medicine, where both individual skill, art, and chance are significant factors in determining success or failure. Despite these challenges, analysis remains indispensable in the field of investment, just as it is with law and medicine. The prestige of security analysis in Wall Street experienced both a brilliant rise and an ignominious fall, a history related but not parallel to the course of stock prices. Security analysis advanced uninterruptedly until about 1927, during a period when increasing attention was paid to financial reports and statistical data. However, the new era, starting in 1927, marked the abandonment of the analytical approach, with facts and figures manipulated to support the delusions of the period. The market collapse in October 1929 was no surprise to analysts, who maintained their objectivity. However, the extent of the subsequent business collapse and its devastating effects on established earning power again threw their calculations out of gear. This led to the double discrediting of serious analysis. First, due to the persistence of imaginary values before the crash, and second, due to the disappearance of real values after the crash. The experiences of 1927 to 1933 were extraordinary, and thus not a valid criterion for judging the usefulness of security analysis. Security analysis can be divided into three primary functions: descriptive, selective, and critical. Each of these functions plays a crucial role in the comprehensive analysis of securities. Descriptive function. This involves marshaling important facts related to an issue and presenting them in a coherent, readily intelligible manner. It also includes revealing strong and weak points, comparing with similar securities, and assessing factors likely to influence future performance. Selective function. This goes further by expressing specific judgments about whether a given issue should be bought, sold, retained, or exchanged. It involves determining which securities or situations are most suitable for selective analysis and identifying the limitations of this approach. Critical function. This involves applying standard to facts to reach analytical judgments. It includes evaluating the soundness and practicability of selection standards, ensuring securities have adequate protective provisions, and critically assessing accounting methods and corporate policies. The descriptive function of security analysis involves gathering and organizing important facts about a security issue. This process includes revealing both strengths and weaknesses, comparing the issue with others of similar character, and assessing factors that may influence its future performance. Descriptive analysis provides an organized factual basis for applying judgment, making it an adjunct not only to investment, but also to intelligent speculation. Let's consider a hypothetical example of descriptive analysis. Suppose we are analyzing the financial position of XYZ Corporation. The steps involved would include collecting financial data such as balance sheets, income statements, and cash flow statements. We would organize this information to highlight key metrics such as earnings, assets, liabilities, and cash flow. By presenting these facts coherently, we can reveal the strengths and weaknesses of XYZ Corporation, compare it with similar companies, and assess factors that may influence its future performance. The selective function of security analysis involves making specific judgments about whether to buy, sell, retain, or exchange a security. This function goes beyond simply describing facts and involves expressing a positive or negative opinion on the security's future prospects. Selective analysis requires a deep understanding of the types of securities or situations that lend themselves best to this approach and the limitations and handicaps that analysts may face. St. Louis San Francisco Railway Company Preferred Stock 1928. This issue was priced at 100 with a 6% non-cumulative preferred dividend. However, the company's earnings history showed that in no year had earnings been equivalent to 1.5 times the fixed charges and preferred dividends combined. According to well-established selection standards, this issue lacked sufficient protection and should be rejected. Owens, Illinois Glass Company Bonds, 1932. In June 1932, these 5% bonds due in 1939 could be purchased at 70, yielding 11% to maturity. The company's earnings were many times the interest requirements, even during the severe depression. The bonds were well covered by current assets alone, making them a strongly entrenched and attractively priced investment. Wright Aeronautical Corporation stock, 1922 and 1928. In 1922, the stock was selling at $8, paying a $1 dividend, earning over $2 per share, and holding more than $8 per share in cash assets. Analysis showed that the intrinsic value was substantially above the market price. By 1928, the stock had risen to $280 per share, earning at a rate of $8 per share, with a dividend rate of $2 and a net asset value of less than $50 per share. The market price largely reflected speculative future prospects, with intrinsic value far below the market quotation. Interborough Rapid Transit Company Bonds, 1933. Both the first and refunding 5% bonds and collateral 7% notes were selling at 62. However, each $1,000 note was secured by $1,736 face amount of 5% bonds, with current income on the collateral being significantly higher for the 7% notes. Despite technicalities, it was clear that the 7% notes were intrinsically worth more than the 5% bonds. Paramount Pictures Preferred versus Common Stock, 1936. In October 1936, the first convertible preferred was selling at $113, while the common stock was at $15.87. The preferred was convertible into 7 times as many common shares and had accumulated dividends of about $11 per share. This made the preferred cheaper and more advantageous due to its conversion privileges and dividend accumulation. Intrinsic value is a fundamental concept in security analysis, representing the value justified by the facts, such as assets, earnings, dividends, and definite prospects. This value is distinct from market quotations, which can be influenced by artificial manipulation or psychological excesses. Historically, intrinsic value was equated with book value, representing the net assets of the business. However, this proved impractical, as neither average earnings nor market prices were governed by book value. The newer view equated intrinsic value with earning power, implying a confident expectation of future results. However, experience showed that past earnings and trends were often unreliable guides to the future, making intrinsic value a more elusive and flexible concept. To illustrate the concept of intrinsic value, let's analyze the J.I. Case Company, common stock as of early 1933. The market price was $30, while the asset value per share was $176. The average earnings over 10 years were $9.50 per share, but the results for 1932 showed a deficit of $17 per share. If we applied a customary method of appraisal, we might multiply the average earnings by 10 to arrive at an intrinsic value of $95. However, the individual earnings figures were highly inconsistent, making the average unrepresentative of typical conditions. Therefore, any intrinsic value derived from this average would be equally artificial. This example demonstrates the challenges in determining intrinsic value and highlights the need for a flexible approach. The relationship between intrinsic value and market price is complex. While intrinsic value represents a justified value based on facts, market prices are often influenced by speculative factors and psychological sentiments. Exact calculations of intrinsic value are often impractical, and analysts must rely on approximate measures. The concept of intrinsic value must be flexible, with the understanding that even an indefinite idea of intrinsic value can justify investment decisions if the current price falls significantly outside the estimated range. The flexibility of intrinsic value is influenced by various factors, including the stability of the business, market conditions, and the reliability of past data. For example, the intrinsic value of Wright Aeronautical in 1922 might be estimated within a range of $20 to $40 per share, while for J.I. Case in 1933, the range could be $30 to $130. This flexibility allows analysts to make informed decisions even with approximate values, provided the market price falls far outside the estimated range. The context and specific circumstances of each case play a crucial role in determining intrinsic value. In certain special cases, security analysis can yield more precise conclusions about intrinsic value. These situations often involve liquidation, technical operations, or arbitrage. For example, in the case of Interborough Rapid Transit Company bonds, a given market price for the 5% bonds results in a clear valuation of the 7% notes. If the collateral securing the notes were acquired and distributed to the note holders, the value relationship would be precisely established. While these cases are relatively infrequent, they demonstrate the potential for more exact calculations of intrinsic value in specific scenarios. The success of security analysis is hindered by three primary obstacles: inadequate or incorrect data. While deliberate falsification is rare, misinterpretation through accounting artifices and concealment of information can lead to incorrect conclusions. Regulations of the analyst's skill can mitigate this issue to some extent. Uncertainties of the future. Future changes, often unpredictable, can invalidate conclusions based on past data. Analysts must rely on the assumption that past records provide a rough guide for the future, making analysis more valuable for stable business and senior securities. Irrational behavior of the market. Market prices are influenced by speculative factors and psychological sentiments, making it challenging for analysts to predict or control market behavior. Analysts must consider market influences alongside fundamental analysis. Sound analysis should theoretically produce successful results even in speculative situations. However, the mechanics of speculation involves disadvantages such as commissions, interest charges, market spreads, and an inherent tendency for losses to exceed profits. Moreover, the analytical factors in speculative situations are subject to swift revisions, and unknown factors may not neutralize each other, leading to unpredictable outcomes. Analysis is better suited for investment situations, where chance plays a subordinate role, allowing the analyst to make more authoritative judgments. Even if analysis provides a mathematical advantage, it does not guarantee profit in speculative situations. The ventures remain hazardous, and the influence of chance often overshadows analytical insights. For example, a player at Monte Carlo might reverse the odds through analysis, but the outcome still heavily depends on luck. Similarly, in speculative investments, analysis can enhance results if conditions are favorable, but may prove ineffective if chance dominates. Therefore, analysis should be viewed as an adjunct or auxiliary in speculation, rather than a primary guide. The critical function of security analysis involves applying standards to facts to reach analytical judgments. This includes evaluating the soundness and practicability of selection standards, ensuring that securities have adequate protective provisions, and critically assessing accounting methods and corporate policies. Analysts must scrutinize capitalization setups, dividend and expansion policies, managerial compensation, and decisions on continuing or liquidating unprofitable businesses. By expressing critical judgments, analysts aim to avoid mistakes, correct abuses, and better protect bondholders and stockholders. To conclude, we have explored the scope and limitations of security analysis, the concept of intrinsic value, and the various functions of analysis, including descriptive, selective, and critical. Despite the challenges posed by inadequate data, uncertainties of the future, and irrational market behavior, security analysis remains a vital tool for making informed investment decisions. By understanding and applying the principles outlined by Ben Graham, analysts can navigate the complexities of the market and identify opportunities for sound investments. If you liked today's video, don't forget to like, subscribe, and comment. Thank you for watching, and we'll see you soon.